All right. So, the usual, is this thing on? All right. Tracy mentioned Dick Ravitch, and a couple of other people have. I want to take a second to just say Dick was an incredible friend to the governing magazine. And what I thought was he worked the intersection of politics and finance. And of course, throughout all these papers, I sit here and think about the finance issues. In this session, we're going to talk about two papers, current issues in state and local finance. The first one, do retiree health benefit promises affect municipal financing? And we're going to have Sarah Holland present that.
Cool. Thanks, Mark. Thank you guys so much. I am super psyched to be here.
Stand close and speak up.
Got it. Okay. I am super psyched to be here. I am learning a lot today, and I hope I can tell you guys something about how retiree health benefits affect municipal financing. This is a project with a couple buddies of mine, Sebastian Batemier at McGill and Sean Wilkoff at UNR, who I think some of you know, who has been to this conference a few times before. The first thing that I want to try to convince you guys of is that this benefit is substantial, right? So right now, depending on some estimates, we're looking at over $1 trillion in retiree health and other post-retirement benefits, which is really actually just mainly retiree health. That's the bulk of it. As some people in this room and some others have tried to quantify, you know, we've already talked about pensions just in the last session. The amount of public sector retiree health benefits is on par with these pension obligations. And we've got some other evidence suggesting that the pension promises affect municipal finance, but the retiree health benefits has largely been ignored. And so our goal here is to just kind of try to fill this gap by asking, how does retiree health insurance affect the ability of the public sector to access financial markets? And hopefully we can convince you that it matters. But I also want to tell you why it matters. And I also want to talk about why promised public sector retiree health benefits are unique relative to pensions. The first, I think, and most interesting thing is that with these retiree health promises, there is a lot of contracting flexibility, way more contracting flexibility than what we see in the pension literature. So the terms of the benefit vary significantly across states, much more than your standard pension benefit of 2% of your salary per year of service. We got a lot more going on because instead of promising a dollar amount, all right, these states are promising a service, right? And that's a really important distinction. And then unlike pension plans, there's a lot more flexibility in changing the terms of the health benefit, right? So I think that there's an understanding that the pensions are all constitutionally protected. That is not the case with the retiree health insurance benefits. Another interesting thing about these retiree health insurance benefits is they are relatively opaque, all right? And reporting only becomes more uniform beginning with the new GASB standards from 2007 that are introduced in 2007, 2008. And so we're actually kind of, you know, where are we at? We're in 2023. We're actually in a new GASB reporting regime. So we've kind of had two regimes. Our paper is going to focus on the first regime in which people are just made aware of what the size of these things are, right? And so we're going to contribute to some of the literature there. And then I think the third interesting thing about public sector retiree health benefits is that these things have been largely unfunded until recently with benefits on a pay-as-you-go system, right? So if a retiree is making a claim, then the public sector employer just says, okay, here's the cash, let's do it then. Nothing set aside. Okay, so given all of these like cool, unique things about public sector retiree health benefits, our question is, how does it all affect financial markets? And what we find, kind of like our headline, is that higher liabilities for public sector retiree health insurance benefits are going to increase municipal bond yield spreads, okay? With the idea that state borrowing costs are going to increase in order to compensate investors for the risk to their promised cash flows. And then we also find that higher contributions to funding, right, so largely unfunded up until now, but as they increase the funding, it's going to lower these yield spreads. Okay, so that's like our headline, and hopefully I've convinced you that this stuff is unique, but I want to dig a little bit deeper and try to tell you what's cool about what we find, right? So not just the headline estimate. So as I said just a second ago, unlike the pension promises in which you're promising a specific dollar amount going forward, we are promising, or the public sector employers are promising, a service, right? And it's going to have an uncertain cost because we're talking about healthcare, right? Something that has grown to like 20% of GDP, right? Or close to 20% of GDP. And, you know, we see a lot of fluctuation in the prices of healthcare. And so I think that part of what we're doing in this paper is not just talking about how this is affecting municipal finance, but I think that we're also shedding some light on how financial markets value healthcare, right? Which we know is kind of a big topic in terms of understanding, like, oh, we spend tons of money on healthcare, and what is the value of this, right? So turning to financial markets, we're getting closer to understanding what's the value of this, and in this sense, we contribute to some of the past literature on health and asset prices, some of it in the muni market, looking at the effect of like opioids on municipal financing or aging on municipal financing, but even outside the muni space, papers looking at the effect of kind of like county level obesity and firm value, right? But as I said before, one of the things that I think is kind of interesting about this promised service in the future is that states have a lot of flexibility in designing plans in order to like mitigate the risk that the service that they are promising is going to cost a whole lot of money, right? So we take a deeper look and we find that there's a lot of variation in plan details, and that for public sector employers who offer insurance plans with less generous premium contributions can actually mitigate the risk that we see in terms of the higher yields in the higher yield spreads in the muni market. So in this paper, we're also able to show basically how the contracting environment or flexibility is going to affect the outcome. Okay, now I'm going to throw like another wrench in my story here. Like, oh, okay, yeah, they can change the terms of the contract, but I've got these like stakeholder employee people who might be covered by collective bargaining agreements who are going to try to prevent you from your ability to renegotiate the terms of the contract. So we take a deeper dive into that as well. And basically what we find is the contracting environment is going to affect the outcomes, and there are higher yields instead in states with more public sector employees covered by collective bargaining agreements. Okay, and so overall, I think that by showing all of these effects on muni yields, we're also taking a next step in the literature that has first and foremost just tried to say like, hey, how big is the health insurance liability? And that's what some of the people in this room and others listed on my slide have done. Okay, so I've basically already given the entire story away. And so now I'll just tell you what we do to get to the conclusion of that study. So we're basically going to use two types of data. We're going to look at retiree health benefit data, and then we're going to look at bond offering yield spreads. So the retiree health benefit data, as I said, was opaque until 2004. This is when GASB statements 43 and 45 are introduced that give states an incentive to report. Most states take the bait. There's a couple of states like Nebraska that are just like, nah, we'll opt out. So it's optional to report, but the big incentives is that when states do report their retiree health insurance liabilities, they're able to use more favorable discount rates in computing the liabilities. We get a bunch of our data, we get all of our data on health benefits from the Pew Charitable Trust Project. So like I said, we're in the first distinct reporting regime of 2008 to 2016. Then we've got some new GASB statements kicking in after that. So we're just going to like focus on first round of GASB, where we've got like total liabilities and assets and how much is unfunded and things like that. And Pew takes all of this from the state comprehensive annual financial and actuarial reports. Then we've got muni data, kind of like the typical stuff that you guys might care about, like yields and issuance amounts and yield to maturity and stuff like that. And we're going to use the offering yield spreads following the literature, and then kind of like basic regression model. We're going to look at the effect on yield spreads of retiree health promises at the state level. We're going to control for all the bond stuff that you care about, like offering type and insurance and stuff like that. We're going to also control for some state level stuff. I think that probably the one that you're going to think is most important is we're talking about promises to retirees. So we are going to be controlling for state level pension characteristics as well. And then we're going to have some fixed effects in there because stuff changes over time, and it matters what month stuff happens, and then it matters what state we're talking about, right? Because Illinois and Florida and Oklahoma and California, they're all different for all of those kinds of reasons. Okay, so that's the game plan. All right. I want to tell you guys, since we're looking at the differences across states, that the promised retiree health benefit liability varies across states. So basically, I'm just giving you a snapshot here. So the darker color is going to be bigger promises. The lighter color is lower promises, lower liabilities, things like that. So you can see that Oklahoma, my home state, doesn't promise the retirees a whole lot, but something like New York does promise a whole lot. But I also want to emphasize that it's not just about the size of the promises. This variation is due to different benefit levels, but also due to different plan design and eligibility criteria and assumptions about healthcare cost inflation, discount rates, and other actuarial assumptions. So there are a ton of moving pieces behind this variability, and we're going to exploit that. Funding also varies across states, as well as over time. And what I really just want to emphasize in this slide, without spending too much time on it, is just because you promise a lot doesn't mean you fund a lot. So we basically, we got all the boxes here. So I promise a little, I fund a little, I promise a lot, I fund a lot, I promise a lot, I fund a little, I promise a lot, I fund a lot, all right? All of those boxes are happening here. One other thing that I want to say is it's also not one-to-one with pension funding, all right? So we've got states that have, very low funding of retiree health benefits, and both very high pension funding and both very low pension funding. And then also high funding of health benefits, right, with high funding of pensions or low funding of pensions. So takeaway, lots of variation here, lots of variation. It's not just like all part of the same story in a particular state. Okay, cool. So I only got a couple of minutes left, and I'll just tell you, I'll just kind of like walk you through our results without spending too much time on it. So we run that regression that I talked about where my dependent variable is yield spreads, and we got, positive effects here. So larger promised retiree health benefits increase yield spreads to compensate investors for bearing the risk. Cool. What if we decide to fund those promises? So that's going to mitigate the risk and the yields are going down. And then instead of just looking at like the size of the funding, what if like we just look at states that fund versus don't fund? And here I'm kind of like, so basically if you fund, that's actually going to increase yields. Why is that? So a couple of things, right? So it could be the fact that once you decide to fund, you set up a dedicated trust, which explicitly says it's protected from creditors, right? Which is kind of cool because I think that there's probably two types of people in the room right now looking at my headline result of, more promises, higher yields. I think that there's some of you who are like, that makes logical sense. And then I think that there's another type of person in this room who's like, wait, why is there an effect at all? Because they should just hose the retirees, right? If they can, right? So maybe that is like kind of surprising that they're not, okay. So I want to spend like a minute and a half talking about the other results. So we're promising a service and we know that healthcare costs vary geographically. So it's in the health literature, it's also in the news. If you live in Minnesota, they do a great job. They're so efficient with healthcare. If you live in Florida, bad job, right? Everything is very expensive. And so we break our sample into states where they've got healthcare costs under control versus states where they don't have healthcare costs under control. And what do we see? We basically see that retiree health insurance liabilities are going to increase municipal financing costs only in my states who have high health costs, right? So it's really only a problem for the states where I'm anticipating, oh, the service that I have promised to these retirees in the future is going to be way more expensive. Lots of flexibility in plan design. For example, states can promise this benefit in several ways. They can either pay a portion of the premium, right? So 20%, 50%, blah, blah, blah. They can pay a fixed dollar amount. I'm only paying $1,000 towards your premium. Or they can pay no contribution at all, right? There's still a benefit to the worker there because you can stay in the risk pool with the other young, healthy workers, right? But you can see that these different plan choices are going to expose the public sector employer to different forms of risk, right? So if you promise a proportion of the premium, right, you're on the hook for a lot if you're the public sector employer. If you're not given anything, you're just letting them stay in the risk pool. That's not a huge promise. Basically, what we find is that states that pay a portion of the premium face the most risk, right? Because that proportion of premium contribution is going to increase, right, as the healthcare costs increase. Okay, and then finally, we talked about collective bargaining agreements. And so when we split the sample into states where a lot of public sector workers are covered by collective bargaining agreements versus not, we find that our effects basically are only present in the states where there is above median union coverage. Okay, I'm gonna not tell you about all the other contracting environment stuff, but it's basically all consistent. I do wanna address kind of like the one question that you have, which is, maybe retiree health insurance is driven by financing ability, right? Versus the other way around, right? So we got an IV regression. We're going to look for instruments that affect health costs. And so what are we going to do? We're going to exploit regulatory reform that varies across states and time. So we look at state tort reform for medical malpractice, right? So tort reform should lower health costs, which should help the states. We're also going to use reforms about nurse practitioner and practice and prescription authority. So looking at states where nurse practitioners can do more, which should lower health costs. And basically our main takeaway is, yeah, when we run the IV, the results hold, so we're good to go. I hope that I've convinced you that promised public sector retiree health benefits affect community finance. Do I think there are limitations of what we do? Yeah, there are several limitations. Do I think that there are some improvements? Yes, probably many, but I don't want to steal Byron's thunder, so I won't talk about those.
Thank you, Sarah. Now we're going to have Brian Lutz be the discussant. Brian?
Okay. There we go. Okay, so I'm really happy to be here today discussing this very nice paper. I do need to start with the somewhat tedious but important caveat or disclaimer that everything I say solely reflects my own opinion and not that of the Federal Reserve Board. Okay, so there's really a lot to like about this paper. I learned a lot. You know, it's fundamentally asking a very important question. Do liabilities for OPEB influence muni bond yields? This is important, as Sarah said, simply because these liabilities are pretty enormous. You know, credible attempts to estimate the size of these using economically reasonable discount rates almost always come in with estimates north of $1 trillion. And just to put this into context, this is equal to about half of annual state and local government own source revenue, and they're largely unfunded, meaning in principle, there's a lot of potential there to cause fiscal distress down the road. And because of this, I at least found it very surprising that this is the first paper to examine this question, and it's great that they're approaching it. There's also a lot to like in the empirics. The panel data fixed effect approach is quite sensible. It's exactly what you'd want to see. And the authors do a lot of work to look at heterogeneity in the effect on yields of OPEB by various characteristics, like the contribution method or the way the plan is set up. All these results come up with results that are quite intuitive in what you would expect. And this really increases the confidence in the results and that they're capturing what they think they're capturing. And the last thing is the authors go to a great length to rule out pension obligations as a spurious explanation for what they're finding empirically. You know, when I picked it up, that was one of the first things I worried about, but I didn't have any concerns after getting through the paper. Okay, so I'll now turn towards, doing my job as the discussant, trying to offer some constructive suggestions. The first is a couple places where I think the paper could do a better job with the discussion and fleshing things out. And Sarah actually pointed to this with an aside about hosing retirees, but I think this point needs a lot more attention up front in the paper. OPEB benefits generally lack strong legal protections, and governments have a lot of latitude to change these. And in fact, they've been paring them back very systematically for about 20 years, particularly during periods of fiscal stress. They'll often cut back. So they'll reduce or eliminate subsidies, they'll close it to new entrants, and in a number of cases, they've just wholesale gotten rid of them overnight. And a number of places have done this successfully. And this raises a really important question. If a government is under sufficient stress to be unable to make its debt payments, or this is a concern, how likely is it that they will continue their OPEB benefits? Which is to say, if they can just shed these, how much should this really be, affecting muni bond yields? I just think the paper would benefit from upfront discussion of this and some establishing of basic facts. Things like what has happened to OPEB benefits in municipal bankruptcies over the last 10 years. And talking about some examples like of what happened in Chicago where these benefits were cut way back. All this said, there are good reasons why this should matter for bond yields. Not all governments are going to be able to eliminate them. Collective bargaining can matter, as Sarah said. And there also may be costs to dropping OPEB benefits, even if you're legally allowed to do so. It may make it harder to attract high-quality workers and retain them. So, but I just think that all this needs to be fleshed out a bit more. The second thing is, we saw results that a lot of the results are driven by states that have high health care costs. And the first thing I thought about this is, well, if you have high health care costs, the actuarial valuation should capture this. It should just be in a higher liability. Why isn't this just captured in the liability? Why does a market participant care if the liability is large because the state has inefficient health care provision or because the state legislatures were generous 20 years ago? Now, the paper goes on to just say sort of quickly, well, it's risk being priced in. But I think we need some discussion of this because it wasn't obvious to me, at least, why this would be more risky. I think the idea is that almost all the rise going forward in OPEB benefit payments is due to rising health care costs, or the expectation as captured by the actuaries. And this may imply greater risk. If national health care costs end up being higher, you're starting from a higher base, then you're going to be more exposed. Also, if you found yourself with an inefficient system, it may grow even more inefficient and imply a little risk. But there needs to be some discussion of this. Okay, another thing I was kind of hungering for as a reader was some intuition for the size of the effect. Is the size of the effect reasonable? This was a general point, but the thing that really kind of caused me a bit of concern was that the IV estimates are an order of magnitude larger than the OLS estimates, and it seems a little tough to believe that both are reasonable magnitude. As I read the results at least, they're showing that for the funding ratio on the IV estimates, that if you move from 0% funding to 100% funding, you're going to have a 300 basis point swing in your muni yield. There are people in the room better positioned than me to judge whether that's reasonable. Seems extraordinarily large to me. So again, just some discussion of that. Okay, so I'll now turn to some places where I think the empirics might be tightened up a little bit. In all the specifications in the paper, liabilities and the funding ratio are explored distinctly in separate regressions. But these measures aren't really substitute measures of OPEB obligations. They are complementary, which is to say, they capture different aspects of the OPEB situation. You can see this very simply by just considering the fact that a large liability implies risk that should be priced in the market, even if it's, quote, fully funded, simply because the accounting rules in that situation allow you to use a very risky discount rate. So, the real sort of natural thing to do here is just enter them simultaneously in one regression. I think that would be the place to start. If you want to use a single measure, it seems kind of equally intuitive that the place to start is just to use the unfunded liability as opposed to the total liability, denominated by state personal income or something. Okay, so the next thing I want to hit is somewhat similar. Heterogeneity in effect by things like the way the plan makes contributions to the healthcare is explored by segmenting the sample and running two separate regressions by the category. And then when we get different coefficient estimates across those two samples, it's declared that these are different. My concern here is that a lot of those, the point estimates are really similar or close enough that it seems very unlikely they're statistically different or even close to it. And again, the kind of logical standard approach in this case is simply to run regression, interact the OPEB measure, say the funding ratio with, the variable of heterogeneity being explored. And then if, the beta 3 coefficient here is precise and significant, you have a meaningful difference. And then the last thing I wanted to hit was the instrumental variable result. So here we're using healthcare cost factors as instrument for OPEB liabilities. So the latitude nurse practitioners have to practice freely without oversight is used as an instrument simply because the more freedom they have, the lower our healthcare costs. The issue here is that instrument or variable approach requires that the instrument is only affecting bond yields solely through the OPEB obligation. And I think a little more could be done to establish this. A first order thing in this space that jumps out to me is, does nurse practitioner status affect Medicaid outlays and how much they cost? If nurse practitioners' ability to practice more freely lowers Medicaid spending, then that's going to be a problem for the instrument. And I think that needs to be explored a little bit. But I'll just end with, this was a really interesting paper tackling an absolute first order question, I would think for anybody in this room, and it's kind of surprising nobody's done it, and I definitely encourage everybody to take a look because I learned quite a bit. So thank you.
All right. I agree with Brian. It's an interesting paper, and having spent a lot of time looking at, again, individual specific instances of OPEB liability in specific jurisdictions, it was interesting to see this overall look and hear his response. What's your initial response to what Brian had to say, Sarah?
So thank you very much is my initial response, because those are all super awesome suggestions. Some of them, yes, I think that we definitely need to consider some of those things. A couple of the things that I want to respond to, just first and foremost, thinking about the nurse practitioner, what I've read is that mostly that's lobbying on the part of, kind of like industry groups, nurse practitioner groups. But I think that we could certainly look into any kind of like correlation between Medicaid expenditures or something like that. I think it's always worthwhile to provide stronger justification for the instrument. In terms of the assumptions about healthcare costs, I guess I just want to say also, when we're splitting the sample based on high health cost states versus low health cost states, so we're getting the data from the Dartmouth Health Atlas, which is specifically looking at expenditures for Medicare recipients, which we think is kind of like nice for our sample because we're talking about retirees. It's unclear to me if when states are making their actuarial assumptions, if they're using individual, like, state level estimates of healthcare inflation, or if they're using just like a national healthcare inflation index. And so, based on my searching to see if there were an index at the state level, I couldn't find one. Like, you can find like, healthcare inflation outpaces GDP by X% or something every year, but it's not clear to me that they're using something more sophisticated and for their state in particular. And yes, I totally agree that we do need to spend more time talking about the fact that there is some tension here about who is going to get paid. And you're absolutely right that states are cutting back on their benefits. I think that there's only one state specifically who has just completely stopped giving these retiree health insurance or OPEB benefits, and that's Idaho, even though they're still on the hook for their retirees that worked under contract, but no more they're going to do this. And I do think that one thing thinking about our paper is then thinking about, like, yes, if they cut the OPEB benefits, then what are the implications in other markets like labor markets? I mean, like Mark was saying at lunch today, I'm talking about having a hard time hiring, right? So there's this tension between you get rid of the OPEB benefits, and then that's like a nice benefit that people who, usually get paid something like below market wage or whatever are going to value. And then as long as my other way of thinking about it is these people are probably still also getting pension benefits. And if I'm getting a pension, then I'm probably also the type of person who values good retiree health care even more, right? Because if I get a pension, I want to live forever so that I can keep collecting that pension over and over again, right? But if I have a defined contribution plan or I've just got a stack of dollars, then like I'm going to jaywalk or like go motocross or something like that, right? So yeah, those are my initial reactions. But seriously, thank you so much for all of your comments.
There are only 50 states, and when I think about cutbacks that you were talking about, Brian, I realize now that I was thinking about local governments, where I would interview city managers and HR directors and CFOs and ask them about their OPEB liability, and they'd say, well, we don't have that anymore. Particularly after the recession in 2010, 11, 12, I'm interviewing people, and they had done away with it. Questions and comments? Well, yes, Mark Jaffe, this is your baby.
Yeah. Thanks for the site. So when I was going through all the OPEB documentation and ACFRs, I noticed that in a lot of cases, there were either caps on the amount that was available to an individual retiree or simply a fixed amount that all retirees received. So to the extent that, do you think that that's the case in the data that you're looking at? Because I looked at 2020, 2019, I think, so it might have been something that was newer. If it is something that affects your data, does that mean that looking at healthcare spending trends is less important because the plan is the OPEB plan is insulated from it? And a quick question for Brian, in your non-official capacity, would you agree with me that OPEB liabilities should be added to the Federal Reserve Z1 accounts of the United States? Thanks.
You want to go first? Give you time to formulate a response?
Yeah. Okay, so I will say so. As I mentioned, there's kind of like two reporting regimes, and this paper is firmly in reporting regime 1, so we stop at 2016. And so the contracting data that we have in terms of whether or not they're making a fixed contribution or they're capped or whatever, that data comes as of 2016. So entirely possible, as part of Byron's discussion, mentioned that they are changing the contracting environment, and so there very well might be these additional caps in 2020 from your data, right, that we just don't have yet. And I mean, my short answer is yes. I think it is entirely possible that with these kinds of new contracts being written, that the healthcare cost situation is mitigated for sure.
So yeah, these are purely my own opinions here, to be sure. I assume you're talking about the financial accounts of the U.S. I think there's kind of two offsetting major factors that would inform that decision. I'm not really sure where it balances out. They did include pensions on an accrual basis, not that recently anymore, but after just huge effort was undertaken to add those. I think adding OPEB liabilities would be conceptually, methodologically quite similar, and given that there was a rationale for the pensions, that would seem to carry over to OPEB. On the other hand, I do think there's a significant difference because the legal protections on pensions are just radically stronger. They make it a durable form of debt that is going to be paid in, at least many future states of the world. My reading of the legal stuff from the last 20 years is that it's just a lot less clear for OPEB, and I think that pushes in the other direction, and I think a judgment would need to be made on how those balance out. But, that's an interesting suggestion. It would, again, my colleagues who did that, it was a massive lift, and that would be another massive lift, but it's an interesting suggestion.
Oh. I guess I get the proximity award for that. So I'm wondering, in the last panel we talked about moral hazard, and then back to the issue of sort of sticking it to the member in terms of reducing OPEB and so on, and the flexibility that is there. I've heard in many rooms in the financial communities in my career of saying, well, if worse comes to worse and they get into fiscal stress, they can just slash and cut the OPEB, and that did happen in a number of bankruptcy cases. But I'm also wondering if you looked at the shift when the ACA was implemented, the state marketplace plans, because I believe there were a number of state plans that said, okay, we're still continuing to provide the benefit, but you got to go to the ACA and buy it, and maybe we'll give you a check to make it a little bit easier. I don't know if you looked at that.
Yeah, no, so awesome question. And yes, we have looked at that, and there doesn't seem to be an effect of the ACA, no difference. Just splitting the sample on kind of prior to ACA implementation versus post-ACA implementation. And so I think that, one explanation is that our sample ends in 2016, so the bulk of our sample is pre-ACA implementation. The other thing that I would also mention is, I think that there was also a hypothesis, pre-ACA passage and implementation, that a lot of private sector firms were going to ditch out of their employer-sponsored health insurance and push everybody onto the exchanges. And most of the research in the health literature suggests that didn't really happen. So that could be the other reason. There were threats of it, but in terms of big time changes, we haven't actually seen a lot of that.
All right, we've only got 30 seconds left. I don't think that's enough time for another question and response. What I would say, though, Sarah, is, this may be the first paper, but you've opened a can of worms here that is worth taking a look at. Thank you.
Thanks.
Thank you. All right, our next paper is the School District Borrowing Capital Spending, the Effectiveness of State Credit Enhancement, and it's presented by Kate Yang of George Washington University.
All right, good afternoon. This paper looks at a long-existing, but I would argue under-examined program called Credit Enhancement Program in states, and I look at its impact on school districts' borrowing costs and their capital spending. So to motivate the paper a little bit, I show you two pictures. On the left is a high school in the Bay Area. On the right is another high school in a relatively small town in Georgia. As you can see, school districts spend capital spending accruals to projects like school facility construction, renovation, purchase of school buses, etc. And also, you can visually see here there is great variation across districts in what they are buying, how much they're spending. On average, or in total, I should say, school districts spend $80 billion a year on capital projects. That represents, on average, 10% of their total spending. 10% is not a lot, but capital spending projects are lumpy. They are big-ticket items that need to be spent upfront, and then the physical assets that are acquired would be good for a number of years. And districts issue, because it's such a large investment, districts issue bonds to finance those capital projects, and the interest they pay vary on those bonds. There is some literature showing that many districts are in need of updating and replacing their building system. So one reason why I'm interested in this project is to see whether kind of access to a credit market is one barrier that might be preventing districts from investing more in their capital projects. And there's also other papers showing that there is disparity, again, kind of supported by the data in districts' capital spending. Unsurprisingly, richer districts, meaning that those with higher kind of property tax base, spend more on a per pupil basis on capital projects. Why do we even care about capital spending? Although evidence is mixed, we believe, at least in some places, there is data suggesting that additional capital investment can lead to increase in academic performances, and also housing prices, showing that residents also care about those type of investments. Okay, so some additional background information, which is not news to this audience. Districts issue bonds, and the bond yields reflect kind of investors' perception about the creditworthiness of those bonds. Districts may pay for underlying credit rating. They may also seek credit enhancement. This is most likely when their underlying rating is low, right? Once they purchase or receive enhancement, I should say, they receive an enhanced rating. A traditional channel of that enhanced rating, or source of that enhanced rating, is private bond insurance. Okay? But what I'm examining in this paper is state credit enhancement programs as a source of enhancement. And this type of program exists in 24 states. They provide an in-kind assistance to districts. I say in-kind because they do not require an upfront investment by the states. So states will essentially commit certain revenue sources to pay back those district debts if districts had trouble paying themselves. Okay, in 14 states, state promises to intercept state aid and use that money, state aid, to those particular districts, and use that money to pay back the district's debt. In 3 states, state statutes contain language about appropriations that will be made when districts are about to default. And in 6 states, instead of a language about appropriation, which still carry certain political risk, the states guarantee or promise to use a guaranteed state funding to pay back district debt. And in 3 states, there are permanent funds available for purposes such as paying back district debt in the case of pending district default, and they are usually considered very safe and pledged because those permanent funds are not competing against other state priorities. Okay, so this paper examines two main questions. First, whether those state credit enhancement programs are associated with lower interest rates paid on districts' bonds. Second, if the answer to the first question is yes, then that lowered borrowing cost we would suspect will translate into increased capital spending by those school districts. And if the answer there to the second question is also yes, one might also be interested in knowing whether that improves academic outcomes. And lastly, I think very importantly, we are interested in this average effect, but we should be more interested in kind of a heterogeneous effect across districts, namely which districts benefit the most from this type of programs. And kind of a preview of the finding, it's the poorer districts, the ones with lower credit, underlying credit ratings. Okay, so to give you some descriptive statistics, also introduce you to the data I'm using in this project. The first data, or the private bond market issuance data. Here I show zooming onto the ratings of the bonds. So looking at school district bonds issued between 2009 and 2019, I show you histograms of 3 subsamples: state enhancement, so bonds enhanced by states, bonds enhanced by private bond insurance, and unenhanced bonds. X-axis, or the credit rating kind of index, right? 0 being unrated, 16 being AAA, and the shaded bars are underlying rating. So first thing you observe is that for unenhanced bonds have higher underlying rating on average than enhanced bonds. Unsurprising, if your underlying rating is really high, you see less of a need to seek enhancement. The hollow bars are enhanced ratings. So post-2009, private bond insurance no longer could provide kind of a AAA rating across the board, but some of the state enhancement programs, perhaps Texas Permanent Fund Program being the most famous and the heavily used, given the size of the state, still provides AAA rating, right? So that means state enhancement programs are actually able to provide enhancement to a wider range of school bonds as compared to private bond insurance. A few more things I would like to talk about with regard to those programs is that I reviewed all the statutes related to those programs and talked to state officials running those programs. Enhanced rating, and a few things are, I think, important to point out. Enhanced ratings are mostly tied to state rating. I say mostly because the exception there is permanent fund programs. For permanent funds, the enhanced ratings are not tied directly to the state's own rating. That means that we have variation across states, but also variation over time. When a state's own rating changes, then the program's rating will change. Second, some programs require application and approval, so this is not unconditional kind of guarantee, right? There is some state involvement in making those pledges. And lastly, just want to point out, I've presented here a few years ago about defaults of general purpose governments. School district defaults are also extremely rare. Okay, so the second source of data are school district data. I'm not going to dive into the details. I look at enrollment, student composition, district financial variables, etc. I'm showing you the baseline statistics, right? Not all districts, there are about 12,000 districts in this country. Not all of them issue bonds. But more importantly, I want to draw your attention to this highlighted in red kind of row of numbers. I break the sample down to by their highest, the district's highest underlying rating during this analysis period. What you see here is poverty rate is negatively correlated with their underlying rating, right? Districts with no and low underlying ratings have the highest child poverty rate. Again, this is showing you that rich districts have higher ratings and poorer districts have lower underlying ratings. I'm very conscious about my time, so I'm looking at I probably won't be able to show you all the results and all the tables I put together, so I want to give you a quick visual preview of the finding. So what I think the main contribution of the paper is that there's another paper showing there's a narrowing gap. There is first a gap between high and rich, poor and rich districts in terms of their capital spending. But that gap has shrunk after the Great Recession. What I'm trying to argue is that narrowing in the gap might be due to credit enhancement programs. So this chart right here shows you the percentage of district bonds that are enhanced by private insurance, the solid line, versus those dashed line, versus those enhanced by state enhancement programs, the solid line. Again, not news to this audience, private insurance really, the percentage really went down after the Great Recession, right? If we look at per pupil capital spending for that same period, it's actually a longer period, but if you look at post-2008 period right here, I split the districts into two groups. First, states without credit enhancement programs on the left, and then state with credit enhancement program on the right. And I look at average per pupil capital spending by districts in the highest poverty quintile versus those in the lowest poverty quintile. So on the left, what you see is that those in the highest poverty quintile, solid line, spends more on a per pupil basis on capital projects than poor districts, right? Again, that's a gap we're interested in. If we care about equity in kind of school finance in the absolute sense, then we do not want to see that gap. And those two lines move in parallel in states without credit enhancement program. But on the right, what you see is that for the low poverty districts in state with credit enhancement programs, the trend is similar to the graph on the left. But for high poverty districts in state with credit enhancement program, it's pretty stable. Per pupil capital spending did not change dramatically. It's quite stable after the Great Recession. And that, I argue, is because of credit enhancement program. Those districts are most likely to participate in the program and benefit from the program as a result. Okay. Now, empirically, as a academic who wants to do rigorous research or perhaps simply publish a paper, I want to be sure that I'm after a causal effect as opposed to a simple comparison, kind of simple descriptive analysis. Unfortunately, state enhancement programs have existed for a long time, so there is not a pre-policy, post-policy comparison I can make, and there is no, of course, random assignment of credit enhancement. I'm essentially comparing cross-sectionally bonds with credit enhancement versus bonds without credit enhancement, or districts year observations with enhancement versus those without. So I make two comparisons, and hopefully, and I'll show you, they generate very similar results. This first comparison is between districts that are always enhanced and those that are never enhanced. So essentially what I'm doing there is compare poor districts who have very low underlying ratings, therefore always participate in the enhancement program, versus those rich districts with high underlying ratings, therefore never participating in the enhancement programs, okay? So that's the first comparison I'm using to assess the impact of enhancement. The second comparison I'm using is kind of a within district comparison. Districts are able, in some states at least, able to receive enhancement only when their outstanding bond levels are low, okay? So I'm comparing within a district bonds that are enhanced versus those are not. I don't have the time to go into the details, but I argue those two sources of variation, or those two types of comparison, should give me two different effect estimates, and they should be biased if any biases exist in different directions. Therefore, my true estimate should lie within. Okay, again, not going into all the details, I want to jump directly into the results. The first one is looking at impact on bond yield. Here I'm using a yield spread to a synthetic kind of risk-free bond. And the first column is kind of that never enhanced versus always enhanced comparison. The second column is a district within the district comparison, which is my preferred specification because it controls for more unobserved factors. Here you see the effect estimates is very consistent. It's about 13 basis point reduction. Okay? And in the third column, I look at kind of the heterogeneous impact across different districts and interact the enhanced variable with baseline poverty rate. Here you can see that high poverty districts, or districts with very high baseline poverty, receive additional yield reductions from participating in this program. And that is perhaps due to the level of rating elevation that they are able to receive when they receive the enhanced rating, right? So in the last column, I essentially created a bunch of indicator variables measuring the level or magnitude of rating elevation from credit enhancement provided by the state. And you can see that the more notches that the rating is enhanced, the larger the yield reduction is. Okay, moving on. Does the lower interest rate or lower borrowing costs translate into more capital spending? Yeah. Very short on time. Just show you this event study analysis graph. Yes, it does. So zero is when the year when a district first received credit enhancement. You see that their capital spending increases. To interpret this result requires some quick analysis. I just cut to the chase. It's about the 2% to 7% increase in per pupil capital spending, depending on how we estimate the useful life of the capital asset. And that benefit, or that increase in capital spending, I should say, happens mostly in districts with low and medium baseline poverty. Okay? Since I'm short on time, I just skip all the way to the last table. I encourage you to take a look at this. I think it's a low-cost program, and I try to calculate the potential benefit if other states adopt this program, and I would argue that this is something state policymakers should look into, because this is really, truly, I think, a low-hanging fruit. Thank you.
Thank you, Kate. And yes, it's a program that clearly states ought to adopt. All right, Christine Cuny will have the response.
Okay, so thank you for the opportunity to discuss this paper. Thank you, Kate, for the excellent presentation. There's going to be a lot of overlap between what she showed and what I show. So this is also a nice opportunity. I didn't know a whole lot about school enhancement, and now I do. So I'm just going to start with a high-level overview. I like to work in pictures, so you'll notice it's very visual. All right, so the basic research objective, as Kate accurately articulated, is that you have these state enhancement programs. They lead to lower borrowing costs. That leads to increased capital spending, which then leads to improved student outcomes. So it's quite a long causal chain with a lot of links. So what are her findings? Okay, so as she showed you, borrowing costs are lower when you have state enhancement. Okay, especially for high poverty districts, which I think Kate really focused on in the presentation, and I encourage you to focus more on it in the paper. I think it's it kind of differentiates the paper a bit to show this heterogeneity. State enhancement also leads to increased capital spending, and she didn't get a chance to show you that there's no effect on test scores. Okay, so all of these findings I think are very reasonable. They're what I would have expected, right? If I had to guess before reading the paper, this is what I think you would have found, right? So my first step in trying to put together the discussion was to say, okay, let's place this in the context of existing literature. What is it that we already know? Okay, so these state credit enhancement programs, the stated purpose of them is to lower borrowing costs and give access to credit markets to school districts that otherwise might not get it, right? Okay, so there is literature, granted it's older, that shows that yes, borrowing costs are lower when you have these state enhancement programs. Okay, now there are caveats, right? So enhanced rates aren't quite as good as a natural AAA. They are better than private insurance, so better than like an AMBAC guarantee or something like that. It's already been shown in the literature, does this work? No. That when you have a lower credit rating, you get a bigger benefit, right? So the adjustment is better, and also when the state program has a better credit rating, the benefit is bigger. Okay, so all of this has kind of already been done, and maybe there's a benefit to showing that it still holds in a more current sample. But what I'm going to focus on is this second link, because I think the second link is the one with the greatest potential to change our priors and contribute to kind of the broader literature. Okay, so if state enhancement programs affect capital spending in a causal way, right? That you have this state enhancement, and for whatever the reason, which I'll talk about in a little bit, your capital spending goes up, particularly in the high poverty districts. Okay, so this is what I'm going to focus on, and I'm just going to give two kind of high-level suggestions to try to bolster this contribution. So my first comment is that I think it would be helpful to benchmark this increase in capital spending against other enhancement options, right? So private insurance is still an option. It's much less used than it once was, but there's still a critical mass. So, is this capital spending increase greater for state enhancement? Is it in some way different than just getting private insurance? And then the other benchmark that I think would be nice to see is direct state aid, right? These districts can, of course, and do get direct state funding for capital projects. Okay, and then my second comment is about the mechanism, nailing down, why exactly does capital spending increase when you have these state enhancements? Okay, so the paper currently articulates that it's because you have a lower interest rate, which of course makes sense, right? You have more money now to spend because you're paying a lower rate. You have better access to the market, all of that. But there's also a possibility that it's just some kind of latent state preference to support high poverty districts. Okay, so with regard to the first benchmark, the private insurance. Okay, so what I'm thinking here is that you compare the two, right? So a district that gets state enhancement leads to some increase in capital spending. Is that more or less than a similar district that just got private insurance? Okay. Now, part of the reason I think this is interesting is a figure that Kate already showed, which is in the paper, which shows the substitution between these two, which isn't surprising, right? You wouldn't think you need two enhancements, really. But when bond insurance kind of dried up after the credit crisis, you see that the state enhancements increase. One thing that I do think is interesting is that the aggregate amount of enhancement is lower now than it once was, right? So if you add those up, it used to be 90% of this market that was in some way enhanced. Now it's, I don't know, roughly 62. So that's interesting, right? Nonetheless, the broader point was that it will be helpful to benchmark these two. And you do have, 20% of the market insured by private insurers. So you have a reasonable sample, I think, to compare. You also have some heterogeneity across states that I think can be helpful here. So I pulled the Texas, the permanent state fund data. Roughly 90-something% of district bonds in Texas are enhanced through that state enhancement program. They do have some that are insured. You can see this bottom line, something less than 5%. But you can see there's substantial heterogeneity across states that would lead to this kind of figure that you see here. Another nice benefit of benchmarking against insurance is it'll help with identification, right? In the sense that you have two districts that chose to be enhanced, and they were granted the enhancement, right? So you're more likely comparing apples to apples. Okay, the second benchmark that I thought would be interesting is to just look at direct state aid. So does capital spending increase more when you have state enhancement or when you just get direct funding? Okay, the reason I thought that this would be a reasonable thing to look at is because of this table too. Okay, so Kate showed this really briefly, but I'm gonna show it for a little longer. Okay, so focus on these first two columns here on the left, the never enhanced versus the ever enhanced. The ever enhanced get greater federal transfers and they get greater state transfers. So there is some kind of selection going on here with who gets enhanced. Also, if you look at the ratings, when you go from low to medium to high, the lower rating districts, they tend to get more federal aid and they tend to get more state aid. So this is something that I think is a potential kind of correlated omitted variable here. So I think it'd be helpful just to benchmark or control for those. Okay, and then finally the mechanism. So I just briefly want to talk about why is the state enhancement leading to greater capital spending. Okay, so the paper's preferred mechanism is that you've got lower borrowing costs, which I think is probably a reasonable story, but I think more can be done to bolster that story. In particularly, the alternative is that there's just some state preference, some latent state preference to support low income districts, and that latent preference jointly determines the enhancement as well as borrowing costs and capital spending, right? Okay, so two suggestions for ways to isolate the mechanism. One is that you're right that all these state enhancement programs have existed for a long time, so there's not a lot of variation. However, in 2011, Texas started allowing their charter schools to get enhancement. So this might be a nice shock to kind of identify, okay, what happens when we suddenly throw in this enhancement option. The second is maybe you could do like a path analysis, where you directly try and link the change in borrowing costs to capital spending is another option. Okay, so in conclusion, I really enjoyed reading this paper. I think it's a very interesting topic and it has a high likelihood of making an impact in academic journals. I think that you can enhance the contribution a little bit more by focusing more on the capital spending piece. Of course, that's just my view. Benchmarking against other enhancement alternatives and zeroing in on the mechanism. So good luck.
Thank you, Christine. That was a great job. One of the things that struck me about the paper, Kate, was that there seemed to be no cost to the state to do this. Where the other alternatives might have some cost, state aid or whatever. Here's something that they could do to lower the borrowing costs for poverty jurisdictions with no impact.
I talk about this in the paper. I did not have time to present. One potential cost would be a moral hazard, our favorite word of the day, to additional cost to states, right? States are essentially committing themselves to bail out districts when districts have troubles, even though I talked about how that rarely occurs, district defaults rarely occur. But if that's the case, then states are essentially kind of sacrificing their own creditworthiness. So in the paper, I looked at whether that's the case kind of from by doing a descriptive analysis, looking at states' geo interest rate and whether that's correlated with the amount of school district debt they are enhancing. And I do not see a statistically significant correlation there, but the sample is pretty small, and I by no means could argue that is causal, but it's showing that that's not a concern. So I'd be interested in learning from other academics and practitioners about why states are not doing this. I talked to the Baltimore county controller, and they are very interested in this program, and they have never heard about it. Maryland actually does not have a program like this, so I wonder if it's a lack of knowledge. I don't know. It's a pretty obscure program in some sense, but yeah.
Your reactions to Christine's comments.
Right. Those are great comments. There is an old literature, right? Again, those have existed for such a long time, and people have looked at them in the 80s. So I'm trying to add some new kind of data to this, and also this is the first national analysis existing. Previous literature looks at this kind of on a state-specific basis, and also I'm bringing in some of the, it's not new methodology anymore, but it's the methodology of the 21st century. And those are, the other comments are all great. I'm going to incorporate them to my best capacity. Yeah, and there could definitely be bias, right? Especially comparing the never enhanced districts to the always enhanced districts. Those are just different districts. I'm comparing poor districts to richer districts, and there could be omitted variable bias. So I'm arguing that since the two different identification strategies give the same or very similar effect estimates, I have confidence this is likely causal, although can't really conclusively say that. I think there are recent new developments in this space that could be very interesting to explore. The Texas Charter example is a great one, and there has been some new development with regard to the Texas Permanent Fund Program. They were getting very close to their limit. Actually, they were at their limit, and then there were legislative attempts to kind of get rid of that limit, and I think they are successful. So kind of looking at those shocks would be interesting, arguably hopefully we would be zooming in onto one state. But I think that could those events could provide opportunities for further estimating kind of a causal impact.
Questions or comments for Kate or Christine? There's a couple here.
Yeah, I just have a question about what the capital spending is. Do you have any idea about that? And I ask because I'm from Texas, and so when I think capital spending, I don't see like nice new classrooms. I see Friday Night Lights. So yeah, do you have any idea about what they're building?
My data do not show me that directly. There has been in education policy research space, there has been some effort to kind of go back to the official statement and look at the kind of language there and try to pull out some statistics regarding whether we're spending money on facility construction versus building stadiums versus purchasing buses. I just don't think we have that data yet, but I think that'd be really interesting to know.
Other comments? There's one over here. While he's getting the mic, there is an $80 billion gap, GAO says, between what we're spending on schools and what we need to.
Leonardo Meyer, WMATA. I just had a quick question about, so you mentioned the moral hazard, which is the buzzword for today, and I just was wondering, what you evidenced that Texas had a pretty successful enhancement program. What frameworks do they have to preventing such moral hazards? Yeah.
I think this is not unique to Texas, although Texas is very unique because their program has a large amount of asset, right? It's kind of going back all the way to when they first used their land to kind of build up their permanent fund program. But I think that's lack of moral hazard, generally speaking, this rare occurrence of school district defaults is related to how well-functioning, I don't know, David has probably more to add to this, kind of well-functioning credit market that we have. I think districts are generally worried that if they ever default, that will affect their future access to the credit market, and that has been, we just don't see that many district defaults.
Way in the back there.
Great paper. Just one thing. Did you or have you been able to make a connection between capital spend and test scores? And because that's for your upcoming book, I know. There's a whole book in there. It would be kind of interesting to know which kind of capital spend leads to which kind of improvement or decrease in test scores.
I always get that question if I were to present this to an education policy cohort, right? They care nothing about yield. They only care about test scores. But yes, Christine mentioned that, and I did not have time to present. I did look at test scores. That's not education outcome. That's not the only educational outcome, right? That's where we have data. And I did look at that, and I do not see a statistically significant impact on test scores. Part of it, I think there's well-established literature about this, actually, because we're looking at pretty marginal increases in capital spending, 2 to 7%. It's not huge. It's really hard to, I guess, make a difference when the spending increases are small. At least that's what meta-analysis performed by other scholars seem to point out. And going back to your second question, because I could not observe on what kind of capital assets school districts spend money on, I cannot directly answer that question.
Hi, Will Kim. Sorry. Question for you. How much of the increase in PAR, which seems substantial, is due to just interest rates being lower and keeping the same debt service burden, right? So the proportion of PAR increases versus an increased debt service level like, that might indicate more access to the capital markets?
When you say, I guess, increasing service level, what do you mean?
Sorry, so meaning like if a school district can pay $1 million a year in debt service payments and interest rates are lower, then, you know, they can raise more money, right? But how much of the increased capital spending was just pure interest rates versus maybe like increased access to the markets or more the ability to finance more, you know, facilities?
I don't think that I can directly measure that, but I can look at the percentage increase, right? The yield reduction is about, I think if you look at the 13 basis point and compare that to kind of average yield, it's about 6%, and the increase in capital spending is roughly around that number as well. So I would say it's, if I were to make a bet, I'd say it's mostly driven by the reduction in borrowing costs, but I cannot, I guess, would I be able to test that directly? I do not believe so.
All right, that's all the time we have. But thank you, Kate, for a great paper, and Christine for great comments.
So we're going to take a break now. We'll resume around 4:45 for our conversation with Mayor Keller of Richmond and Mayor Stoney of Richmond and Mayor Keller of Albuquerque, unless they've made a change in my absence.